What if I told you there was one account that you could contribute to that could grow tax-free, and in retirement after the age of 59 and a half, you could also take it out tax-free, and it could equate to hundreds of thousands of dollars in tax-free retirement money in the future? No, it's not a life insurance policy, I promise. In today's video, I'm going to talk to you about what a Roth IRA is, how you can use it even if you are a high-earning individual, and even how I use it in my own personal. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player, and I'm currently a financial advisor for professional athletes and entrepreneurs. Today's video is all about one of my favorite types of retirement accounts, a Roth IRA. So let me break it down for you. A Roth IRA is simply this. IRA stands for Individual Retirement Account. So we've talked about 401ks in the past. With an individual retirement account, it works just the same way as a 401k. It's just not sponsored by a company. It's your individual retirement account. But just like any other sort of retirement accounts, the government says we want to give you some sort of benefit if you want to contribute to this account. And what that little Roth prefix in front of it means is you are going to get an incredible, a future year tax benefit. But you're not going to get that current year tax benefit. We always talk about current year versus future year. The future year tax benefit is this. The money that you contribute to a Roth IRA gets to grow tax-free, in my case, Lord willing, for decades before I take it out. And that is an incredible advantage. So I want to break down what the contribution limits are, how you can get around contributing to a Roth IRA if you're a high earning individual, and how you can actually open a Roth IRA for yourself. So let's talk first about what the contribution limits are. In 2025, if you make under $150,000 and you're a single filer, or you make under $236,000 married filing jointly, you can contribute directly to a Roth IRA. So this is very simple. You can go to any of your major custodians, Vanguard, Fidelity, Schwab, and you can open up a Roth IRA account, and you can take money from your paycheck, from your savings account, and contribute it to that Roth IRA. Now, for everyone else saying, wait a second, but I earned a lot of money this year, can I still contribute to it? And this is one of the biggest misconceptions that I see out there. People see a Roth IRA and they say, oh, I can't contribute to it. No, you still can. And here's the workaround for it. You can do what's called a backdoor Roth IRA contribution. And the way to do this is you need to make sure, first and foremost, your IRA account has a zero balance, your traditional IRA account. Then you have your Roth IRA account. What you're going to do in step one is you're going to contribute to your IRA account. You are going to let it sit there. I recommend 48 hours, and then you are going to convert it or move it to your Roth IRA account. So in this scenario, we have two accounts. The IRA account has a zero balance. We put our contribution in there. We let it sit there for 48 hours, and then we convert it or we move it to our Roth IRA account. This is how you, as a high earning individual, can still take advantage of this incredible retirement account. And this is what I've been doing for the past 15 years of my personal life. Every single year, I make a backdoor Roth IRA contribution. In 2025, the limit for contributions is $7,000. Now note, there is a catch-up contribution, just like there are in 401ks, up to $8,000 for those over age 50. For everybody else, $7,000. I will note, this often goes up. So if you do it in 2025 and you're thinking about doing it next year, make sure you understand what the contribution limits are for next year. Now, a couple things that I want us to understand with Roth IRAs. This money is going to grow tax-free. The other big benefit to this money that I love for high net worth and ultra high net worth families that we help serve is that it's not subject to RMDs. RMDs is required minimum distributions. And essentially it works like this. The government says you can contribute to a retirement account and you can get a tax benefit for it. But at some point, we are going to make you start taking money out of that account. And frankly, it kind of makes sense. They've been giving you this tax benefit along the way, and they're saying, we want our pound of flesh. So they make required minimum distributions. And what that means is for people that aren't even using the money in their account, you have to start pulling it out. That is the beauty of a Roth IRA. It is not subject to those required minimum distributions. So for high net worth and ultra high net worth families that often aren't using a lot of the money that's in their retirement accounts first, or using taxable assets that they have, a Roth IRA is a hugely advantageous account. Now, $7,000 might not seem like an incredible amount of money to you, but what I will tell you is that $7,000 compounded over years and decades, or multiple decades in some cases, can turn into an incredible amount of money. This can become one of the biggest tax moves you can make. Because again, just like any retirement account, we need to think about not just our contribution strategy, but our distribution strategy. And what I love about Roth IRAs is that the distribution strategy on them provides the ultimate flexibility. No RMDs and no taxes. So after the age of 59 and a half, you can take that money out and do whatever you want with it. One other big benefit of Roth IRAs is the contribution that you make, that $7,000 contribution, you can actually take that money out in the future before age 59 and a half. So it gives you even more flexibility. Now, one common mistake that I see with those contributing to Roth IRAs is they do everything right. They either directly contribute to it if they're under the income limits, or they do the backdoor Roth IRAs correctly if they're over the income limits. But what they fail to realize is that the investments that we make in a Roth IRA should be specific to that account. And here's what I mean. You want to have your highest expected rate of return in that account. So if you are a risk-adverse person and you have a lot of bonds and you don't have a ton of stocks, well, put your stocks in that account. And the reason for that is, remember, this money is going to grow tax-free and you can take it out tax-free in retirement. So we want our highest appreciating assets in this account. Do not put assets in this account that are lower appreciating. If you have bonds, but you also have stocks, put the stocks in there, not the bonds. This is a huge mistake I see. Or I see people that are invested the same across the board. All of their accounts look the same. You want to make sure that the most risk you're taking is potentially in that Roth IRA account, because that money is going to grow tax-free. As always with this tax series, I'm trying to break it down from the most simple concept down to some more specific concepts like the Roth IRA. If you missed earlier videos in this series, make sure you go back and watch them. And as always, guys, my goal is to help you get smarter with your money. So make sure you subscribe so you don't miss any future videos. Until next time, my friends.